What happened in the silver market didn't look dramatic at first. There was no official announcement, no emergency press conference, no single headline explaining it all away. But something changed. And for those watching closely, it was obvious that a line had been crossed. Not a psychological one, but a structural one. Silver moved into territory it wasn't expected to reach, at a time it wasn't supposed to get there. And the response was immediate. This wasn't about enthusiasm or speculation. It wasn't retail traders chasing momentum. It was about control. When markets move in ways that threaten assumptions, systems react, sometimes quietly, sometimes forcefully. And what made this moment different is that the reaction didn't come after chaos. It came before it. If you follow markets to understand how power, policy, and pressure really interact beneath the surface, make sure you're subscribed. This channel focuses on what happens before the explanation becomes obvious, when decisions are still being made behind closed doors. Silver has always been treated as manageable. Important, yes, but contained. A smaller market. A secondary asset. Something that could move without forcing larger consequences. That belief shaped how risk was modeled, how exposure was structured, and how much attention it received. But when silver pushed beyond expectations, that belief started to crack. The key issue wasn't the price itself. It was what the price implied. A move like that suggested tightness where abundance was assumed. It suggested demand where elasticity was expected. And most importantly, it suggested that paper mechanisms were losing their ability to smooth reality. That's the moment institutions pay attention. When silver moved the way it did, it put pressure on hedging structures, on margin assumptions, and on the idea that volatility could be managed reactively. Risk models don't like surprises. They especially don't like surprises in markets that feed into broader systems. And silver feeds into far more than most people realize. At the same time, physical considerations don't care about models. Industrial users don't hedge based on narratives. They hedge based on continuity. When a price move signals potential disruption, behavior changes quickly. Not publicly, quietly, contracts get adjusted. Preferences shift, flexibility disappears. That combination is dangerous for a system built on leverage. When paper expectations and physical reality start diverging, the gap has to close somewhere, and it rarely closes smoothly. Intervention becomes tempting because it buys time. It restores order on the surface. But it doesn't remove the underlying tension. This is why the response mattered more than the move. Someone stepped in because allowing the move to continue unchecked would have forced a repricing of risk elsewhere. Not just in silver, but in related markets, funding assumptions, and confidence more broadly. That kind of repricing doesn't stay contained. What most people missed is that this wasn't about stopping a rally. It was about preventing a signal from spreading. Signals are dangerous because they travel faster than policy. Once markets start drawing conclusions, reversing them becomes difficult. We're still early enough that this can be framed as technical, temporary, contained, but those explanations only work while confidence holds. And confidence is exactly what gets tested when markets behave in ways they're not supposed to. The reason moments like this feel confusing is because they sit in a gray zone between normal volatility and overt intervention. On the surface, markets are still functioning, trades are clearing, prices are printing. Nothing looks broken enough to justify alarm. But beneath that surface, behavior starts to shift in ways that don't line up with the visible narrative. That's where the real story lives. When silver moved beyond what models were prepared for, it didn't just challenge price expectations. It challenged timing. Many risk frameworks assume that certain moves take time to develop. They rely on gradual adjustments, on liquidity stepping in, on arbitrage smoothing out extremes. When a move accelerates faster than those assumptions allow, The framework itself becomes the problem. This is where institutional sensitivity kicks in. Large players don't need chaos to react. They respond to probabilities. If a market begins behaving in a way that increases tail risk, even slightly, exposure gets reassessed. Not publicly. Internally, quietly, limits get reviewed. Hedging costs get recalculated. Scenarios that once felt remote suddenly matter. Silver is particularly sensitive here because it connects multiple layers of the system. It isn't just a traded asset. It's a hedge, an input, and a signal all at once. Changes in its behavior ripple outward. A sharp move affects derivative books. It affects industrial hedges. It affects funding assumptions tied to collateral and margin. That interconnectedness means even a contained move can feel outsized to those managing risk. At the same time, physical dynamics don't wait for financial consensus. When a price move hints at tightening conditions, behavior changes on the ground. Buyers become less flexible. Sellers become more selective. Inventory stops circulating as freely. These shifts don't show up immediately in official data, but they show up in decisions. And decisions compound. This is the tension point. Paper markets assume continuity. Physical markets operate on availability. When those two drift out of sync, the system loses its buffer. Volatility increases not because participants want it to, but because the mechanisms designed to absorb stress stop working efficiently. Intervention in this context isn't about manipulation in the dramatic sense. It's about containment, slowing the signal, buying time, restoring a sense of order so adjustments can happen without forcing immediate repricing elsewhere. From a system perspective, that makes sense. From a market perspective, it's revealing, because stepping in acknowledges something important. It acknowledges that the move wasn't just noise, that it carried information the system wasn't ready to digest. And when information has to be managed, it means confidence is being protected, not celebrated. What's easy to miss is that this kind of response doesn't resolve the underlying issue. It redirects it. Pressure doesn't disappear, it migrates. It shows up in different instruments, different tenors, different behaviors. The surface calms, but the structure keeps adjusting. This is why focusing only on whether silver goes up or down next misses the point. The significance lies in the fact that it moved in a way that forced a response at all. That's the signal. And once a signal has been sent, it doesn't get erased. It gets remembered. We're now in the phase where explanations will lag behavior, where narratives will try to simplify what is, in reality, a structural adjustment. Understanding that distinction is what separates observers from participants. What makes this phase especially unstable is that once a market forces intervention, the rules change quietly but permanently. Even if prices pull back, even if volatility fades for a time, the memory remains inside the system, risk models are updated, assumptions are revised. What was once treated as improbable is now treated as possible. And that single shift has consequences far beyond the original move. In highly leveraged systems, stability depends on predictability. Not perfection, but range. When a market behaves outside its expected range, it forces everyone connected to it to reassess exposure. That reassessment doesn't happen all at once. It happens layer by layer. First in derivatives, then in funding. Then in risk appetite more broadly. By the time the effects become visible to the public, the internal adjustments are already well underway. Silver sits in a sensitive position because it intersects with multiple forms of leverage simultaneously. There is speculative leverage, which gets the attention. But more importantly, there is structural leverage tied to hedging programs, inventory financing, and cross-market exposure. Those positions are designed to function smoothly under normal conditions. They are not designed for surprise acceleration. When silver moved the way it did, it increased uncertainty in places that rely on calm. Volatility metrics adjust upward. Margin requirements become less forgiving. Correlations that were assumed stable start to wobble. None of this requires a crisis. It only requires enough doubt to justify caution. And caution in leverage systems feels like contraction. This is how pressure propagates without headlines. A hedge that becomes more expensive leads to a position being reduced. A reduced position leads to thinner liquidity. Thinner liquidity leads to sharper moves. Sharper moves reinforce the perception of risk. The loop feeds itself, not emotionally but mechanically. What complicates matters further is timing. These adjustments often happen when broader conditions are already strained. Bond markets are sensitive. Funding costs are elevated. Confidence in policy responses is thinner than it appears. In that environment, even contained stress can feel outsized. The system has less room to absorb it quietly. It's important to understand that none of this implies collapse. Systems don't need to fail to change. They only need to lose flexibility. When flexibility declines, optionality narrows. Participants become less willing to take risk, less willing to provide liquidity, and more focused on protecting balance sheets than pursuing opportunity. That shift alters market behavior in subtle but meaningful ways. Rallies become sharper and shorter. Pullbacks feel more violent. Reversals happen without warning. To an unprepared observer, it feels chaotic. To someone watching structure, it feels transitional. This is also where narratives start to diverge from reality. Public explanations tend to focus on price action. Up days are framed as strength, down days as weakness. But the deeper story is about function. Is the market clearing smoothly? Is liquidity dependable? Are assumptions holding? Those questions matter more than direction. Once a market has forced a response, it doesn't simply return to its prior state. The system remembers, and that memory shapes behavior long after the headlines move on. What history shows is that once a market reaches this point, attempts to restore normality rarely succeed in the way people expect. Calm can be reintroduced temporarily, but the underlying structure doesn't reset. It adapts, and adaptation under stress always comes with trade-offs. In past cycles, markets that triggered early intervention didn't collapse immediately afterward. Instead, they entered a new phase where behavior became more cautious and more reactive at the same time. Liquidity providers stayed active, but selectively. Volatility didn't disappear. It changed character. Moves became faster, less forgiving, and more sensitive to relatively small inputs. This is where many participants misread what's happening. They assume that because prices stabilize, the issue has been resolved. In reality, stabilization often means risk has been redistributed, not eliminated. Pressure that was concentrated in one place gets spread across the system. That makes it less visible but also harder to contain. Silver's role in this phase becomes symbolic. Not because it's driving the system, but because it reflects broader tension between control and reality. When a market tied to both finance and physical demand behaves unpredictably, it highlights the limits of management. You can slow signals. You can smooth price action, but you can't force confidence to behave on command. Another historical pattern is the widening gap between official explanations and lived experience. Public narratives emphasize order and continuity. Participants operating inside the system experience tighter conditions, reduced flexibility, and greater sensitivity to shocks. Both perspectives can exist at the same time. That's what makes this phase confusing. This divergence is also where credibility becomes fragile. If markets sense that stability is being maintained through intervention rather than balance, trust erodes incrementally. Not enough to cause panic, but enough to change behavior. And in financial systems, behavior is everything. The longer this phase lasts, the more difficult it becomes to return to a prior equilibrium. Adjustments compound, new norms form. What once felt extreme becomes tolerated. What once felt normal becomes unreachable. This isn't failure, it's transition. What matters most here is expectation. Those waiting for a clean resolution are likely to be disappointed. Systems under strain don't offer neat endings. They evolve through periods of uncertainty, recalibration, and uneven outcomes. Recognizing that process early is what allows observers to make sense of the noise. We are now in the part of the cycle where the visible moves matter less than the invisible ones, where the decisions happening quietly carry more weight than the headlines everyone is watching, and where understanding structure matters more than predicting direction. What ultimately defines the final stage of moments like this isn't a dramatic reversal or a single event everyone can point to. It's a lasting change in how the system behaves. Once a market has forced intervention, even briefly, the idea that everything is under control becomes harder to sustain. The surface may look calm, but underneath, priorities shift. At this stage, participants stop assuming that stability will be provided automatically. They become more selective about risk, more cautious about exposure, and more attentive to signals they once ignored. Liquidity becomes conditional. Flexibility narrows. Decisions that used to be routine require more justification. None of this makes headlines, but it reshapes outcomes over time. Silver's role here is not about price targets or predictions. It's about what it revealed. When it moved in a way that required a response, it exposed a system that was less comfortable with surprise than it appeared. That discomfort doesn't disappear once the immediate pressure eases. It lingers in the form of revised assumptions and altered behavior. This is why focusing solely on the next price move misses the point. The significance lies in the shift that has already occurred. The system has acknowledged a boundary it wasn't prepared to see crossed. Once that happens, confidence changes in subtle ways, and subtle changes, when layered, become structural. For most observers, this phase feels unsatisfying. There's no clear resolution, no definitive outcome to point to. Instead, there's a sense of drift. Volatility flares up unexpectedly. Correlations don't behave the way they used to. Explanations feel incomplete. That discomfort is not accidental. It's the natural result of a system adjusting under pressure. The risk for most participants isn't being wrong about silver. It's assuming the environment will return to the way it was before the intervention. History suggests it rarely does. Once flexibility is lost, it doesn't come back easily. Markets adapt, but they adapt around new constraints. If you've followed this entire breakdown, you've already done the most important work. You've shifted focus from spectacle to structure, from headlines to behavior. That perspective doesn't eliminate uncertainty, but it makes it navigable. I'd like to know what you're seeing as these changes continue to play out. Are you noticing tighter conditions, faster reactions, or reduced tolerance for surprise? Share your thoughts in the comments. These conversations matter when the signals are subtle. And if this analysis helped you see beyond the immediate move, consider sharing it with someone who's still focused only on the price. What happened here wasn't just a market move. It was a message.